I have lived through more market storms than I can count, and I can tell you the pattern repeats in every era. People ride the euphoria up, they forget risk, they load up on whatever is hot, then the floor drops out and the same question returns. How did you make money when everyone else was losing? The real answer is simple and it is not flashy. You make money in crashes because you prepared long before the crash arrived. You owned the right mix. You kept dry powder. You knew which businesses would stand when the dust settled. You gave yourself ballast with safe bonds. You anchored yourself with real world assets that do not vanish when a screen turns red. Think about how many different flavors a crash can take. The oil shock bear market in the 1970s, the one day collapse in 1987 that felt like the world was ending, savings and loan failures that rolled through the early 90s, the Asian financial crisis that dragged down markets in 1997, the hedge fund failure in 1998 when a single highly leveraged firm threatened to topple the global system, the dot-com bust in 2000 that shredded free cash flow like dreams, the global financial crisis in 2008 that took down household names, the downgrade scare in 2011, the China and oil scare in 2015 and 16, the late 2018 sell-off when liquidity disappeared into the holiday season, the COVID shock in 2020 that sent the market down a third in weeks, the inflation bear of 2022 that punished long duration assets across stocks and bonds, different triggers, same lesson. You survive and then you thrive if your portfolio has four functional parts that work together under stress. Cash is everyone's least favorite asset until the day it becomes their favorite asset. In quiet times, people say cash yields too little. In panics, cash is priceless. When the screens go red and bid-ask spreads widen and forced sellers appear, cash lets you act. You can buy great assets without needing to sell something else into a thin market. You can be the friendly capital that gets paid for showing up when it is uncomfortable to show up. In 2008, there were iconic examples: preferred shares with juicy coupons and equity warrants attached, senior capital into blue chip names at attractive terms. Those terms were available because the buyer had patience for years and then courage for minutes. That is how opportunity often looks. You do not need billions to apply the idea. You need a rule and discipline. Hold an emergency reserve for life first, and hold a strategic cash sleeve for investing. Size it by conditions and by your personal risks. Raise it when optimism is loud and valuations are stretched. Spend it down when fear is loud and prices are cheap. Just never let it fall to zero. Never lock yourself into a position where you must sell good assets at bad prices to raise money you could have kept in cash. High quality businesses are your compounding engines. They are the reason a portfolio can fall and still be stronger 10 years later. When I say quality, I mean a business with a moat that does not disappear when the cycle turns. A moat can be a global brand that customers reach for without thinking. It can be a network that becomes more valuable as more people join. It can be scale that lowers your unit costs below any rival. It can be switching costs that make it painful for customers to leave. It can be a hard to retrobly distribution system that took decades to build. Whatever the mode is, it should be rooted in the real world and in customer behavior, not in buzzwords. Quality also shows up on the statement of cash flows. Real free cash again and again through good and bad years, a habit of paying owners in dividends or buybacks only after reinvesting in the core balance, sheets that carry modest debt and no maturity, cliffs that could force a fire sale, leadership teams that think like owners and communicate in plain language, businesses that sell goods or services people will keep buying even when budgets are tight, soap and soda, utilities and rails, payment networks, software with mission critical use, medical products that improve outcomes. These are the kinds of franchises that survive every storm and then take share when the weather clears. Think of 1987. Prices collapsed in a day, but the cash registers at the best companies kept ringing. Think of 2000. Many companies never came back because there was no cash and no moat. The ones with real economics grew stronger. Think of 2008. The weakest balance sheets failed. The durable franchises endured and then multiplied as weaker rivals faded. Think of 2022. Expensive stories with cash flows far in the future got crushed by higher discount rates. Firms with present cash and present pricing power held up much better bonds. Look boring until you remember what they do for a living. They reduce the amplitude of your experience. They give you time. They put a floor under your plan when stocks are falling. High quality government bonds tend to catch a bid when fear hits equities. They are not perfect. In 2022, both stocks and bonds fell because inflation shocked the system. That is a reminder to own duration sensibly and to revisit your mix as conditions change. But across many cycles, a sleeve of safe bonds has been a reliable way to turn a free fall into a manageable descent. You can tailor the bond sleeve with simple rules. As you age, increase your stabilizers. Use the safest instruments for the core, like government bills, notes, and bonds, and only add highly rated corporate credit at the margin. Ladder maturities so you are not a forced seller. Reinvest coupons. Understand that the job of your bonds is not to excite you. Their job is to let you keep your equity engines and your real assets through ugly months without losing sleep or needing to sell. Real assets are the part of the plan that remind you the world is physical, not only digital. A productive farm keeps producing regardless of the latest headline. A regulated utility keeps delivering power and collecting checks. A well run railroad keeps moving freight because the economy needs it. A distribution warehouse in a location that businesses cannot replace simply because it took 20 years to entitle and build will keep its tenants. These assets may not shoot the lights out in good times, but they hold value in bad times and they pay you for waiting. You do not need to buy a railroad to benefit from the principal. You can own shares of companies that own hard assets and generate steady cash. You can own real estate investment trusts that focus on essential infrastructure. You can own your primary home in a prudent way that fits your income and keeps your leverage conservative. The point is to have something in your mix that will not go to zero and that ties your plan to the real economy. Put these four together. Now imagine the tape in 2 different years. First picture, 2008, you go in with a cash sleeve, a short list of great companies you want to own more of, a stabilizer in safe bonds, and an anchor in real assets. The market drops by. Half your plan says rebolence. You trim a little from the assets that held up to add to the engines that fell. You deploy part of your dry powder into the few businesses you have studied for years. You do not try to catch the bottom. You buy in stages. You keep a reserve. You keep going. When the recovery comes, your worst month is behind you and your best years are ahead of you. Now picture 2020, the market drops a third in a few weeks. Liquidity vanishes. Headlines scream. You open your plan, the same one you wrote when the sun was shining. It says to keep cash, to average in, to protect your time horizon. You do not sell your best names. You do not sell your anchors. You let the bonds do their job. 6 months later, the tape has healed. A year later, you are higher than ever. What felt like the end of the world was a violent but temporary detour for a portfolio that was built to outlast news cycles. Preparation is half the battle, psychology is the other half. Crashes attack your nervous system. They push you to act fast and usually to act wrong. The antidote is a checklist and a routine. A checklist you write when you are calm that tells you what to buy, what to avoid, what to rebalance, and what to ignore. A routine that limits how often you stare at the tape and expands how often you reread owner letters and study financial statements and listen to calls that explain real cash dynamics. A routine that includes pre-committed ad levels for your favorite names so your future self does not hide when prices are scary. There are a few behavioral traps to anticipate. Loss aversion makes a 20% drawdown feel worse than a 20% gain feels good. Recency bias convinces you that the last 3 months will repeat forever. Hurting nudges you to buy what is popular near peaks and to sell what is hated near lows. Overconfidence tells you that this time you will time the bottom. To counter those instincts, moment pieces of your plan. Use scheduled contributions to add regardless of mood. Use rebalancing bands that trigger mechanical trims and ads. Use valuation guardrails that keep you from paying any price for a story. Use position limits that keep a single name from owning you. Valuation matters. It is not a timing tool, but it is a compass. When the market is cheap across many measures, your future returns improve. When it is expensive across many measures, your forward returns shrink. You do not need to predict the next quarter. You only need to change your posture at extremes, hold more cash, and keep new buys small when multiples are stretched and everyone is celebrating. Hold less cash and be bolder when multiple compress and everyone is convinced that stocks are broken forever. Quality matters even more than valuation. A fair price for an exceptional business is often a better long-term deal than a cheap price for a mediocre one. Exceptional businesses grow their value through cycles. They improve through recessions. They come out with more share and more pricing power. Mediocre firms rely on the cycle to bail them out. They are hostages to credit markets. They beg for tailwinds. When those tailwinds stop, the math stops working. Taxes and costs matter. Turnover burns returns. Every switch invites a spread, a tax, and an error. Own things that you can hold for years. Harvest losses deliberately in bad years to build tax assets that can offset gains later. Put the least tax efficient assets in tax protected accounts where possible. Relentlessly cut fees and frictions. Compounding loves low drag. Liquidity structure matters. Build three buckets: a life bucket for 6 to 12 months of expenses so your family never needs to sell risk assets to pay bills. A medium term bucket for known obligations in the next 1 to 3 years with very low volatility instruments. A long term compounding bucket for equities and real assets that you will not touch for many years. Then, when a crash arrives, you look at your runway and realize you do not need to sell the things you most want to keep. That single realization converts panic into patience. Risk is not a single number. It is the chance you cannot do what you need to do when you need to do it. It is the chance a permanent loss occurs because an asset you own goes to zero. You reduce real risk by refusing to buy what you do not understand, by refusing to borrow against volatile assets, and by refusing to put a short term need in a long term vehicle. You reduce risk by choosing simplicity over fragile complexity. You reduce risk by saying no to what everyone is chasing when you cannot explain how the cash will come back to you. Let us walk through a few more concrete scenes to make this vivid. 1999. The market tells you that profits do not matter. Price to clicks is the new metric. People quit jobs today trade if you had the four-part plan you underperformed during the last leg of the mania and it felt annoying. But you owned cash, you owned a handful of quality companies with real earnings, you owned stabilizers, you owned anchors. When the air came out, you were not stuck in names that would never recover. You had a watch list of boring cash machines you were happy to buy at half price. You averaged in over months while others argued online. 5 years later, the patience looked like genius. 2011. The market dropped on a downgrade scare. The headlines were grim. You opened your plan, it told you to rebalance and to check liquidity. You trimmed some bonds that had rallied and bought a bit more of your favorite businesses that had fallen. You did not guess the next headline. You respected your process within months. The fear passed, your discipline paid you twice. You bought low and you reinforced the habit you can use again. 2018 liquidity vanished into the holidays. Selling fed on itself. You had set rebalancing bands back in the spring. When the band tripped, you bought a measured slice of your quality names without overthinking the trade. You did not bottom tick, but you were buying during forced selling. The first quarter of the next year did the rest. 2022 bonds went down with stocks and the shock felt different. You adapted within your framework. You shortened your bond duration so the stabilizer could resume its role. You increased your allocation to quality businesses with strong near-term cash who could raise prices without losing customers. You added a little to real assets with pricing power. You kept cash because uncertainty was high. You did not chase the riskiest tech rally after the first bounce. You let time and cash flows work, and you were ready to be more aggressive when inflation started to turn. Notice the pattern. You never needed a perfect forecast. You needed a repeatable structure that makes good decisions likely and bad decisions harder. You needed the humility to be a little early and a little late rather than all in or all out. You needed the courage to act small when fear is loud and to act again and again as prices get better. You needed patience for years and courage for minutes. There are practical ways to make this easier. Write a one-page investment policy for yourself. Include your target ranges for cash, for high-quality equities, for safe bonds, for real assets. Include rebalancing bands that will trigger action without drama. List the exact businesses you're willing to average down on with the rough valuation levels that would make you excited to add. Note the red lines that would make you sell, such as a moat that is clearly shrinking, a balance sheet that is deteriorating, or management behavior that breaks trust. Commit to reviewing this page twice a year and during any panic, tape it inside the cover of your notebook. Let it be the anchor when the news is noisy. Build a research rhythm. Pick a handful of businesses to study deeply. Read the last 10 years of owner letters. Read the proxy statements to understand incentives. Read the notes in the financials where the truth hides. Listen to the calls when times are tough, not only when times are easy. Visit a store. Use the product. Talk to a customer if you can. This kind of real world homework is what gives you conviction to buy when the chart is ugly but the business is fine. Respect position sizing. Even great businesses can face temporary shocks. Cap your single name exposure so one mistake cannot sink the ship. Respect cash flow, timing. If you know you will need money for tuition or a down payment within 2 years, do not park it in equities and hope. Put it in safe instruments now and sleep at night. Use simple math to keep yourself honest. If a company cannot explain how it turns revenue into free cash in a way that you can write on a napkin, pass. If your expected return on a stock assumes perfect conditions for a decade, pass. If an asset requires you to check the price every hour to feel safe, pass. You are building a fortress, not a casino. In every crash, there is a moment when the narrative says this time is different. Sometimes it is right about the cause, but wrong about the outcome. The cause is always new. The outcome rhymes. Human nature does not change. Panic sells good assets to raise cash. Forced liquidations create silly prices. The patient buyer with real cash and real homework steps in. Months later, people call it obvious. It never feels obvious in the moment. That is why you write your rules in advance. You also keep perspective. The market is not a monolith. Even in the worst years, some sectors and some factors hold up. Value can outrun growth in inflation shocks. Defensive cash cows can outrun cyclical names in recessions. Small caps can snap back hardest off the lows. International markets can lead when the dollar weakens. You do not need to guess all of this. Your rebalancing and your diversified engines will naturally push you toward what has become cheap and away from what has become crowded. One more scene, imagine. You are marrying a younger investor who lived her whole career in an up-only world until her first real bear market arrived. She calls you and says everything is down and nothing works. You walk her through the four parts. Show me your cash runway. Show me the list of companies you promised to buy lower. Show me the bond ladder. Show me the real asset anchors. Show me the rebalancing bands. Then you ask, have any of these businesses lost their moat? Have the customers stopped needing the product? Have the balance sheets broken? If not, the plan is to buy modestly, to keep some in reserve, to keep showing up while the crowd sells. You remind her that the money is made not by predicting the moment of the bottom, but by staying in the game with a prepared structure. Years later, she thanks you, not for a clever trade, for a boring plan that worked. When you combine cash, quality businesses, safe bonds, and real assets, you are not promising yourself a smooth line. You are giving yourself the right to remain rational while others are emotional. You are building the capacity to be a provider of liquidity when liquidity is scarce. You are tilting the odds so that the longer you play, the better your outcomes get. If you want a concrete starting checklist you can read aloud and then act on this week, here it is in plain language. Build or top up 6 to 12 months of living expenses in true cash so life never forces you to sell risk assets. Decide a target range for dry powder to invest, perhaps 10 to 30% depending on conditions, and promise yourself you will never let it hit zero. Choose 5 to 15 great businesses you understand well enough to add when they fall by a third or more, and write down the specific reasons they are great. Set your stabilizer with safe bonds sized to your age and responsibilities, and shorten duration if inflation risk is high. Add a real world anchor through shares of companies with hard assets and steady cash, or through prudent property exposure that fits your income. Write your rebalancing bands so trims and adds happen without drama. Decide in advance how much you will buy in the first 10% drop, the next 10%, and so on, and keep something in reserve. Revisit this plan twice a year, and during panic, speak it out loud so it is real. Crashes will still sting. That is the price of admission for equity, returns that beat inflation over time. But with this fortress in place, a crash becomes a period of work rather than a period of terror. You will read, you will measure, you will buy a little, you will buy a little more. You will refuse to sell the best things at the worst moment. You will let your anchors anchor. You will let your stabilizers stabilize. You will let time do what it always does for patient owners of productive assets. If this resonates, take one action today. Audit your current mix against the four roles. Find the weakest link and strengthen it. If you have no cash, build it. If you own stories with no cash flows, replace them with real businesses you can explain. If your bonds are risky, upgrade them. If you have no anchor to the real world, add one prudently. Then share this plan with someone you care about so they do not have to learn the hard way in the next storm. Subscribe, share this with a friend who needs a calm voice, and keep your playbook close. Patience for years, courage for minutes, preparation always. That is how you survive every crash. That is how you compound through every recovery. That is how you build wealth that lasts.